Futures in positive territory this morning. Join us now for a look at the markets. Lori Calvasina, she is RBC's Capital Markets Head of U.S. Equity Research. Good morning.
Good morning.
And the question that I would ask you is, what do we do in this sort of topsy-turvy world of both? We're getting all these earnings reports, but I can't tell whether I'm supposed to focus on that or focus on what Trump is saying about tariffs in China.
So I think, unfortunately, we have to deal with both right now. I've been running all over the place the last few weeks, and I will tell you, I was in London for a bit, up and down the East Coast. There's a lot of things that investors are worried about right now. Not a single person over the last 3 weeks mentioned to me an escalation of the China-U.S. trade war. Just wasn't on anybody's bingo card, and we're sitting at peak valuations. So when you get those unexpected bits of bad news, rather, it does take a bit of a toll. That being said, I think we're seeing valuation multiples stuck at peak levels from the last 10 years. They're not going up, they're not going down. This is an earnings-driven market, and I think where this market goes from here is going to depend on the composition of earnings the next few weeks.
And what are you expecting in that regard?
So, it's lumpy by sector, to be honest. And we're starting out with financials. I've told people enjoy it. I'm overweight financials. I like this sector. They've been very, very resilient on earnings sentiment. We've generally seen a deceleration in the rate of upward revisions across the board. Financials has been one of the exceptions to that rule. It's come in a little bit, but not a lot. Tech has been another. And I will tell you, tech, the top 10 market cap names, the AI trade, that's where the earnings strength, that's where the earnings resilience is. There's a lot of jitters as to whether or not that's going to endure. And then you look outside of that, the tariff-related sectors, industrials, materials, earnings revisions are falling, margin expectations are falling. Companies are managing through very well, but they're getting some bumps and bruises. So we don't expect a ton of resilience out of that latter part of the market. We like the financials, and I think tech is the wild card.
What do you think about small caps right now?
I feel like I'm screaming into the abyss on this one. Everybody loves them. I'm an old small cap strategist, spent 7 years of my career covering them, still talk to a lot of small cap PMs. If you talk to the small cap PMs right now, they're frustrated because while there has been a burst of outperformance that we really saw start around Jackson Hole, it's a very low quality composition. So most of them are underperforming their benchmarks. It's a weird kind of surge that we're having in here. I think that what's essentially happened is that the hedge fund community did what they always do, is put on some rate cut bets, and now we've basically got the cuts priced in, and we've seen this trade fizzle out a number of times since 2023. I think it's going to fizzle out again, or at least is at risk of it, because you're seeing jobs growth decelerating. ISM is stuck in a rut. Generally, you need to see those things moving up for small caps to outperform. Not just a good economy, but a hot economy. Or you can break the economy and have a good one coming out of the recession. But a 1% to 2% GDP backdrop with decelerating jobs growth, small caps don't normally do well then. Okay,
so then layer on top of that then the tariff issue, which is how do you even model that into the situation? Do you take the position, I think as some investors do, that China and the U.S. will somehow work this out and that it won't be a terrible situation? Do you take the position on the extreme end that it's going to be a horrific situation?
I feel like I'm middle of the road on this one as well. I keep thinking back to a lot of the commentary I heard at the beginning of the year, sort of a transition period, short-term pain for longer-term gain. I think companies are doing a beautiful job of managing through, but I don't think they're superheroes. And I think there are some realities on the ground they have to contend with. And I think what's bothered me about markets is kind of in June and July, we went from the conversation with investors going from, well, we paid the price to economic ripple effects from the tariffs to, oh, there aren't going to be any economic ripple effects. And I like that word ripple effect because I think that it is survivable. I don't think it's a disaster. But I do think that, we've got some upward inflationary impacts. I think that there's going to be some messiness on demand. Margin expectations, again, they came down between June and Labor Day for all of the tariff-related sectors, healthcare, industrials, materials, consumer discretionary. Those are just some realities we have to work through. So I like stocks next year, but I think there needs to be a short-term period of digestion. Digestion meaning that the market is going to correct? I think that we have, the risk of a 5 to 10% drawdown, and frankly, probably closer to 5 than 10, but something in kind of the 6,100 to 6,400. And okay, so if 10% is your low or your negative case, what's the upside? The upside, you know, I think if I go back and look at some of our sentiment work, our cross-asset work, I mean, they were pointing to kind of like 6,500 as the sort of the top end of where we deserve to be. And you can always overshoot that. And in fact, we have this year. But I think
there is no upside is what I think you're saying.
I think the risks are a little bit more skewed to the downside in the short term. But I do think that once we get into next year and we've worked through some of these issues and we get better visibility on longer term earnings, then I think that we can move higher. But I think we've got some work to do first.